Now, inflation is a little bit different because that affects their ability to make payments. So because of that, anytime we're buying one of these loans, we're working in at least a 25% equity spread. So the price I pay for the note versus the property value, there's at least a 25% spread in there to hedge against any kind of downturn in the market, any kind of, possibility that we take this back. We at least know that our principal is covered and that it's protected.
Chris G here again, and it's a Titan's Tale Thursday, and we've got a Titan all the way from Canada, north of the border, from around Alberta, Canada, and his name's Nathan. Nathan, we're going to talk about some real estate today, fixing and flips, which I love, mortgages and so forth. But Please help me welcome Nathan Turner. Nathan, welcome.
Hey, thank you so much. Very glad to be here.
Nathan, can you tell a little about yourself before we get going here into our discussion of real estate and so forth?
Yeah, absolutely. Nathan Turner. I'm, like you mentioned, I live in Canada, just outside of Calgary, Alberta. So if anybody's familiar with the Calgary Stampede, that's a big deal that happens every year. And so I'm sandwiched right between Calgary and the Rocky Mountains, the Banff area. And it's as beautiful as you've heard if you've never been here.
I've seen pictures. I've been to Canada a couple of times. It is beautiful up there.
Yeah.
You all got a lot of trees, a lot more than we do.
We do. A lot of trees. Yeah.
A lot of trees. Hey, tell me. Now, we talked earlier, and I mentioned fix and flips, which I've done quite a few myself. What possessed you to get into fixing and flipping houses?
It was back, if you think back, 2005, 2006, I think partially I got to attribute it to TV. I was watching, back then it wasn't even HDTV, it was TLC. And I think they even had some on Discovery Channel back when everybody had cable. And we'd watch these people doing their fix and flip on TV. And my wife and I would watch that and think, we could do that. And it happened to be a chance conversation, actually. It was somebody that was trying to sell me on a multi-level marketing thing, and which I wasn't interested in, but in the course of the conversation, she mentioned that Saskatoon, Saskatchewan real estate market was booming. And if nobody's ever heard of Saskatoon, that's fine. Most people haven't, but it's middle of the prairies in Canada, small city of 200,000 people, literally nothing but wheat fields and canola and potash. That's everything that's got going. And she mentioned that, and I thought, really, Saskatoon? Like, I've been there. My dad was born there. There's not much going on, but okay. So I called up a friend, and he confirmed. He said, yeah, this is Saskatoon. It's just absolutely moving and shaking. And I thought, no way. So that was kind of the beginning of it. And my wife and I were very methodical about it. I was living in Montreal at the time, so that was a 3.5-hour plane ride. And
Saskatoon?
Yeah, out to Saskatoon.
Oh, wow.
And then I would pack up my suitcase full of tools and a sleeping bag and sleep on the floor and work all day. It was great.
Ooh. Well, I was one of the mentors of my real estate said, I didn't listen to him, but but I always wanted something close that way, because if we got too far away, it was really a hassle. And he was right, but sometimes they're worth it if you get the right job.
The market conditions were perfect, so it worked out well.
What's what was the worst one you've ever done? You got any horror stories?
Flip. It was my very first.
Do you have any other ones that have been horror stories for you? You get in there and they're just plumb nasty.
I think the biggest horror story for me was it was, getting into 2007. I'd done 7 or 8 of these, and this is I think my 8th.
Yeah.
We're flipping it, and I could feel it. Something was going to change. I could tell the market was just on the edge, and I couldn't sell that house fast enough. So it sat on the market for 6 months, not doing anything. And I ended up being a landlord. And at the time I thought that's what you do. That's what people do when they got real estate. You either sell it or rent it. And I figured out pretty quick that I didn't like being a landlord, not at all, especially from across the country.
Well, that makes it even harder. Well, all your flips in Saskatoon?
They were all in Saskatoon. Yeah.
Well, my first flip, I won't go into details, but we didn't know it. We knew the house was in some, I wouldn't say dire straits, but it had a very particular stench to it. and had been lived in by some animals.
Okay.
And we bought it. And before we we're all gung ho and we show up and we want to start tearing carpet out and so forth. And your eyes are watering, your nose is burning. And the neighbor come over. And I never even had to ask. He goes, 12 cats, 6 dogs. Okay.
That'll
That
do.
before and after pictures. And we made good money on that one. Probably could have
Uh,
made more. But anyway, those are always fun. And I did become a landlord. So we
yeah.
could probably share some landlord stories. But you started a fund back in, you said 2009. Is that right?
So I've been a note investor since 2009. I actually started the fund just last year.
Oh, pardon me. I didn't put two and two together. Sometimes
Yeah.
I'm a little slow.
No, that's good.
My wife thinks I am. That's good for her too.
I don't
No,
think that's very clear, so that's good.
no, that's all good. So, okay. So what happened in 2009? Well, I know what happened here in the States. Did it happen in Canada too?
To a large degree, yes, but not quite the same as in the US.
Mhm.
Things got slow and prices went down some, but we didn't see the crash in valuations in the properties like we did in the US. That
Was
it
it
kind
hard?
of
Was it hard to
sorry,
get a loan?
it was very
Yeah.
difficult to get a loan. And so those are the kind of things working against what we had in Canada. But where there's difficulty, there's often opportunity. And that's what ended up being the case where a friend of mine, he had networked into a group of investors from California. They bought a bunch of properties out in Midwest, had no business getting into that kind of a deal. They didn't know anything about real estate. The idea was they were going to buy this portfolio, flip it out to another group. And then, of course, things went sideways. And by the fall of 2008, they were full on panic mode, not knowing what to do with this stuff. So my old partner and I, the commission that we got was just make lemonade out of these lemons. And that was it. So we had no operating budget. We had power of attorney over these 60 properties spread out in, I think, 18 different cities or something like that.
Oh, wow.
And so that was our commission. So we kind of thought we'd invented seller financing. We were a couple of Canadian boys where it's not really done in Canada.
Right.
So I thought we were pretty smart. And that was the beginning of my note education was selling these properties on terms, creating a bunch of notes. I didn't even know that's what they were called. We were calling them contracts. And doing some more research, found somebody that was teaching about buying the kind of contracts that I was making. And that's it. That was the beginning of my actual formal education.
Sure.
And a lot of trial and error after that.
I've done some of that too. Do you like it better than being a landlord?
I do. I like it a
It's a
lot
good
better.
deal. Yeah. Well, you get to help people too.
Yes.
Can you explain to people, my listeners, what that is? So I know what we're talking about because I've been doing it since a long time, but kind of explain the differences.
So there's a couple of different ways you can approach it. At the beginning, like I say, we were creating notes. So we own the property and we're selling it on terms, with a down payment and a monthly payment. The idea being there that the person living in the house, they're the one responsible for the house, any upkeep, any repairs, anything like that. And then they're making a monthly payment with principal and interest. So
you were
that's
the bank, right?
we're acting as the bank.
Yep. Okay.
And then as I've kind of morphed over time, it's become more of, I will let somebody else do all that hard work. I just want to buy the existing note. So they've created it. They've made this note, and now they want to cash out for all kinds of different reasons. And they would rather have a lump sum of cash today instead of payments over time. I'm in the opposite situation where I would prefer those payments over time. So I'll buy that note off of them, cash them out, and then I become the new bank in that case.
You're buying it at a discount, I assume?
Yes.
A lesser, yeah.
Yeah.
A discount, basically, ladies and gentlemen, is where people get their money in advance, not as much as they're selling at a less than they would have in the future. And that's basically what Nathan's done.
Yeah. And it's great. I like that I get that same cash flow. That's the piece I did like about being a landlord, was that monthly cash flow. But all the headaches that went along with it, that was not so much fun. But this way I get all the cash flow that I liked without the headaches. So that's my new preferred real estate investment strategy.
Sure. So today's episode, we're going to talk about basically how my entrepreneur listeners can other ways make money in
Yeah,
real estate and so forth, and then talk about you and how you've evolved that over time. I asked you earlier, you have a wife and some children.
I do. Beautiful wife, 3 kids. Life is good.
Do they participate in the Did they participate in the flipping of the houses at all?
When I was doing the flips, they were too young. They were just babies at the time. And so
Them lucky things.
they couldn't even lift a hammer. But as time has gone on, I would love to do another flip, especially with my youngest son. He's just turned 15 here in
Oh yeah,
next week. So it's time for him to, get his hands dirty.
you can learn a lot, a lot.
Absolutely. So I'm open to that opportunity. If one comes up, I'd be all over that. That would be tremendous. That's a lot of.
How do you do the math, deciding what was a good deal and what wasn't?
That's a great question. There's when you're looking at buying a note, there's a few things that go into that. Anything from where the property is located. If it's in Texas, that's a completely different thing than if it's in New York. Just when I got started, and there's a little bit of preamble to this, when I got started, everything was non-performing, meaning nobody was making payments on those mortgages I was buying. So having been through that cycle, now when I'm looking, I'm buying performing notes these days where people are making payments, but I think maybe I'm a little tainted where everything I look at through the lens of there's a very good chance that they're going to default. They're going to quit making payments.
Well, you almost have to, don't you?
You do, and I think
Yeah.
it's a healthy approach. It helps keep some safety in there. But with that kind of lens, where it's located matters, because in Texas, a foreclosure is a lot faster and easier than it is in New York. New York, I've done that, unfortunately, and over 2 years to get a foreclosure done. Or it's like Illinois, same thing. I'm actually still fighting one on eviction that's been going on for 4 years now, which is just bonkers. But so location, that matters, and a small town versus a larger center. I'm looking for property or towns of at least 20,000 people. And with the thinking is, if I take that property back, I want to make sure I can actually resell it, and it's not just going to sit there as the old Johnson house where nobody can actually see it as their house, because that's the old Johnson place. So there's those kinds of things that go into it, kind of those intangibles. And then there's the actual numbers. So I'm looking at things like interest rate. What was the interest rate? What's the posted interest rate right now on that loan? What is the unpaid balance? When's the beginning of payments? When's the end of payments? When's the last time they made a payment? All those kinds of things are factors that go into evaluating that loan and making sure that it is what I think it is. So there's your long answer to your short.
I hear you. There's a lot. Well, I say there's a lot into it. It's once you get used to it, it's not that involved.
Right.
It can be some numbers and a lot of number crunching.
Yes.
It can be. So,
yeah.
And you got to know how to. Now, not necessarily in the notes, but when you're fixing and flipping, you got to have an idea what the costs are involved to repair things and so forth, and labor. You're not going to do it yourself.
Exactly.
What I want to say, have you always been I want to say self-employed. Have you always been on your own?
I have, yeah. So before all the real estate stuff, it was a Curves franchise. We had 2 of those up in Canada as well, back in Montreal. And
Curves,
which was
as in the exercise curves?
the women's gym.
Yeah, I know what you're talking about.
So we opened our first one 2004. It was going well enough that we decided we should open up a second one a year later. And by the time we sold in 2009, we had combined the 2 of them down into one. And then instead of selling for 200,000, we ended up selling just the one for 20,000. So in the end, it was not great. Yeah, just the timing of it. 2009, again, if you think back, when people are worried about finances, what's one of the first things they're going to cut out of the budget? That's their gym membership.
Right. I can do that. Home is what they think, and
yeah. So it worked against us, but looking back, my wife and I have talked about this several times. I don't know that I would change anything. As stressful as, difficult as those times were, there's lessons that you can't learn any other way, really. You got to experience it.
So from my listeners' point of view, would you recommend franchises to anyone? Not particular franchise, just a franchise idea. A system already ready to go in theory.
I'm not totally opposed to it, but I think that if you're going to go that route, you should understand that you're most likely buying yourself a job. I think the most successful franchises, from my observation, are the ones where the owner works in the business, and that just for keeping an eye on things and just for costs and all those kinds of reasons. I think that's just something you got to be aware of, and at least at the very beginning. And could you build up 3 or 4 or 5 of those franchises and then hire somebody to watch after it? Absolutely. But in the beginning, especially, I think you need to just understand what you're getting yourself into.
Is it because, so if I had a bigger franchise with more money to invest, like I could say McDonald's, that's a simple one.
Sure.
You got to have people working there, but you're suggesting being the boss there until you get established. And I know that usually they send the franchisees up to, the Oak Brook, Illinois, where outside Chicago, where you go to McDonald's University and
Right.
you got to learn it all. So
yeah,
I can see that.
So it's like I say, it's not necessarily a bad play, but just understand that. And a lot of these, McDonald's is maybe an exception, but somewhere like Curves, the margins are not huge. So just for a cost cutting measure,
Right.
you may want to consider, putting yourself in the business and not paying somebody else to be there.
I once looked into hotels, and that is I want to say a rich man's game. You got a lot of cash.
Yes.
And how they make it all work. And there's other industries like that too, car washes. I looked at a car wash one time, and if you don't have the cash to buy it outright, it doesn't work.
It just doesn't. Yeah.
It just doesn't. You can't pay interest on that. So when I realized all that good stuff, realized that hotels are really great once they've been built once, and then they kind of go bankrupt and somebody buys it later on and puts a different franchise in it. Those work pretty good, but you still have to have cash. And there are just some things that are protected, that are good investments, protect the value of your cash that you have, and better than putting them in the bank, for example.
But like you mentioned, like the McDonald's University, and a lot of franchises will have that kind of a thing, which if you've never done anything with business, I found that really helpful. Going down to the Curves University, I think they called it, where, we learned the systems and we learned the, sales techniques, and all those kinds of things were really, really useful when we were first getting started. So plus and minuses, but just make sure you're aware. That's all.
Sure. Now you got an expo. We're gonna talk about it later, but
Sure.
I'm bringing it up for the reason of, do you teach people about the mortgages and so forth? Like, say if I call you and say, hey, I'm interested in doing some things with you, Nathan. Do you educate people, or your customers already kind of know the idea, and you're just applying some funds?
Yeah. The people that call me wanting to know more about it, I will talk to you for a couple hours and I'll share what I can share, but I don't do any kind of formal training. Sure. I've got some colleagues and friends that do that, and I'd be happy to pass you off to some of them that they do a fantastic job and they've built it all out. For myself, I'm more looking just for passive investors, people that are not looking to do it themselves, but just put their money to work for them.
Well, tell me about your fund that you started, the Ernest Fund, or Ernest Investing, excuse me.
Yeah, Ernest Investing. So Ernest Investing, we started that just last year. Regulation D 506C fund. So if anybody knows what that means, and if you don't, that's okay. But is
that a Canadian fund, or is that a Canadian code or a U.S. code?
That's U.S.
Okay.
Yeah, everything I do, actually, I should have said that earlier. Everything I do is in the U.S. I just happen to live in Canada.
Well, I didn't know. It's an IRS number, apparently, right?
Right.
Okay.
So it's a government regulated. So in government's infinite wisdom, they've stipulated that a 506C fund is only for accredited investors, which means somebody who makes $200,000 a year or has a net worth of over $1 million outside of the primary residence. And for some reason, somebody who makes $200,000 a year is more qualified than somebody who makes $150,000 a year to make investment choices.
Yeah. I did some day trading stuff, and that's whatever. So
Yeah.
yeah, that's the rules they make. So
Yeah, those are the rules. Unfortunately, I mean, let's have a conversation, but those are the rules. It's a fund where you put your cash in there. It's a minimum $50,000 investment. We pay an 8% annual return, and I'll mention that's not a projected. That's not a we think we'll do that. No, that's what we pay. We pay out 8%. And it's an open-ended fund, so if people want to put their money in and a year later decide they want to take it out for some reason, that's fine. I may need to sell some notes before I can get your cash back, but as soon as capital is available, absolutely you can pull out.
what are you doing with those funds? Investing in real estate?
All notes, first lien,
All notes. Yeah.
yeah, performing mortgages, deeds of trust, land contracts, contract for deed, anything with a lien against property, first position.
What caused you to do this? Did you see an opening opportunity or something coming along that, or maybe it's just secret they can't tell me, which is fine too. I just understand that.
No, not at all. No, so it was like I say, when I got started, it was all about non-performing notes where people were not making those payments. And those are a lot of fun to deal with. You can get really good deals. 2018, 19, we were starting to see the pricing just didn't make as much sense. It was getting more and more expensive to buy these non-performers. And you got to understand, like there's so many different ways that a non-performer can exit. So it makes it difficult to predict both returns and timelines on that. So the further we went along, and then COVID hit, and it actually gave me just a minute to step back and think, where we had different investors. We had like 23, I think, different investors, and because we were not structured as a fund, I had to keep everybody's money separate. I had to keep everybody's reporting separate and everybody's accounting separate. So my poor wife was the one who was putting together the reports for the accountant every 3 months, and she was not enjoying that. And so, so it was really her going, really, is this the best way we can do that? And I thought, well, no, there is a different way we can do this. And so we went to that fund structure. The catalyst, honestly, was just administrative difficulties. It was just hard putting it all together for all those different investors. So with the switch, now it's one report, it's one set of accounting, one set of books. And then when we send out that quarterly report, that's a much, much easier task. So that was, like I say, the catalyst. And then we started looking at all the benefits for the investor as well. Then you're part of a larger pool. So we're buying performing notes. Let's say, we've got 100 notes in there, and then let's say 10% of those go bad. So 10 loans all of a sudden stop paying for some reason. In that kind of a situation, it's not that big a deal because we've got 90 others that are. And then on top of that, I've dealt with non-performing notes for many years. I'm well-versed on how to deal with those and how to turn them around one way or another. So it added protection, added safety for the investor, far more predictable timelines and returns. All of those different things kind of pointed towards it's about time. Get on it, do it now.
As a entrepreneur team, or business owner, excuse me, do you have a team?
It's my wife and I run the show, and then we've got different attorneys in different states where we need them, different realtors where we need them, servicing companies where we need them. So not directly employed, but certainly a team that we work with on a daily basis.
How's it working with your wife?
It's not for everybody, but we work really well together.
Yeah. My wife says she can work with me. Well, we're exact opposites, so that's okay.
Yeah.
She likes her time alone.
Yeah.
Anyway. So, are you teaching the kids anything like that? I know is your son the oldest?
My son's the youngest.
The youngest, okay.
I've tried, honestly. I've sat him down and said, look, here's how this works. This is what I'm doing. And my middle daughter,
yeah,
she has at least clicked in. She's like, oh, that's really cool. That sounds really like, I understand how that works. I'm like, yeah, I know. It's fantastic, right? And the other two can't be bothered.
Much. Yeah, that's all right. I used to think we were all made to be entrepreneurs, and I've changed my mind about that. I think we can get into the taxes, but I think there's a ways around the taxes they don't want us to. The IRS doesn't want us to be, but I think we'd all be self-employed and write off expenses, but that's not how the government wants us to work. So
Right.
anyway, I tried to, when my children were young, I set them up with a purse company, online purse sales. It didn't work out so
Yeah.
well.
All
And
right.
she didn't like the idea, but anyway, it was fun for a while.
Yeah.
And then the other ones would make jewelry. There's a hint, well, I'm not getting into politics, but
Yeah.
there's a discussion, there's a thought going around that the economy is going to, the stock market's going to crash
Right.
for multiple reasons, like it
Yeah.
did in 2008.
Yeah.
What kind of, I guess, hedges are you making to make sure when the economy comes that you're doing in your business?
Yeah. That's a great question because it's going to affect things one way or another. Now, here's the thing is with notes, we've got a couple of things going for us. Number one is, interest rates can be high, rates can be low. Whatever the borrower agreed to when he bought that house, the terms that were set out in that mortgage, that stays the same. So whether, once they're locked in, rates can go up, rates can go down. It doesn't make a difference to that borrower. Now, inflation is a little bit different because that affects their ability to make payments.
Mm-hmm.
So because of that, anytime we're buying one of these loans, we're working in at least a 25% equity spread. So the price I pay for the note versus the property value, there's at least a 25% spread in there to hedge against any kind of downturn in the market, any kind of possibility that we take this back. We at least know that our principal is covered and that is protected. So that's a big one. We're looking at borrowers that have made payments. On some occasions, I'll look at like a brand new note where they're a brand new borrower. If they've gone through the whole qualification process and there's a whole background on that, Dodd-Frank, blah, 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 blah. But,
Right.
but they've been qualified, let's put it that way. Not by the seller, but by an independent third party. So they've decided through their processes that the borrower is qualified to make those payments. In that case, I would look at it and make a determination. But otherwise, we're looking at people with a pay history. And of course, just because they made a payment last month doesn't mean they're going to next month, but it's a good indication.
Sure. Just for my listeners, Dodd-Frank is you can Google it. It's basically a law. It kind of sets up the rules for identifying quote unquote good borrowers and not good borrowers, basically. And that's a very big level. So there's a lot more details in it, but that's not what this is about. But if you're interested, just Google Dodd-Frank and it'll explain. So when I've done spec houses and sold them.
Mm-hmm.
I've done, I got rentals obviously and that type of stuff. And I've got a lot of landlord stories. Now I had turned it over to a property manager, so I don't have to deal with that as much.
Yeah.
But people ask me, so, well, what happens if the economy drops? I said, well, it's not really about the economy. And I think you agree with this because like you said, the interest rate is the interest rate. If it's fixed.
Right.
And the more important thing is if people can make the payment or there's jobs available or they're working to make the payment. Yeah, the value of the property can fall, but it really doesn't affect anybody.
Right.
As long as they're not trying to sell the house.
Right.
And there's where the problem comes in because you can't sell the house for the amount of money that you probably owe on it.
Yeah.
So if you don't plan on moving anywhere, it's not a bad thing.
Yeah.
It's just keeping a job and hopefully you've been there long enough or your industry is good enough and you're making that payment. So people get scared, they get all upside that they're upside down. At the end of the day, it's not that big a deal. It's kind of like the stock market. You got stocks and they drop in value.
Yeah.
Well, that's just what do I call it? Perception, right?
Yes.
It's just it's how everybody feels about it at the time.
Right.
And it comes up and it goes down and so forth. So it's always in theory going up if in our perfect world.
Yes.
And I guess over time it is. But we don't want it going up because of inflation. We know that. So
yeah.
So the other thought, the reason I brought it up, one of the reasons I brought it up, is that there is, like in 2008, there's a thought that people are going to, I guess, not go default on their loans.
Mm-hmm.
And if I was so I'm talking to my people out here, my listeners. So if I'm thinking I got some extra cash, I used to tell people you look at properties at least, and you said 25%, at least 20% of the value of the property that you want to buy it at.
Right.
Is that a fair number still?
Yeah, that's a fair number. And so let me add one more piece to this is, if people do default and things happen, life happens.
Right.
And
And it's nothing they did wrong. It's just they lost a
yeah.
job for whatever reason.
Now, the great thing is I'm not a bank. So and I've had a lot of experience doing this over the last 15 years where we start talking to people and say, okay, so, you're not making payments, obviously. So what are we going to do? How are we going to fix this? And most people are, they want to fulfill their obligations. They know that they've signed their name to this and they want to do it what's right. Most people. And so what ends up happening is we can say, okay, so let's have a look. Your payment was $800. Is that feasible? Can you still afford that? Or, maybe you lost your job and got something new. Does that work? And if the answer is yes, then great. Then we figure out something to do with the arrears. That can be, they can pay it over, we can split that up over the next 2, 3, 12 months, whatever. We can tack it onto the back of the loan. We can do all kinds of things with that. If that case is where $800 is too much, look, I lost my job, I got this new one, but it doesn't pay as well. Okay, what's a reasonable number? Could you do 600? And if they say, well, yeah, I can do 600, great. Then we can modify that loan and make it so that their new payment is now $600. And because we got this at a discount to begin with, we have the room to be able to do that. And because I'm a human being, not a bank, I am far more flexible. And we can work in all kinds of different solutions and different, workarounds to make sure that people stay in their home. The bottom line is I've done a lot with properties and, taken back a number of properties over the years. My ideal situation is not to own property. I don't want to own property. So I'm motivated to help you stay in your home and just make payments. That's my business. I would just want to collect payments. I don't want to deal with houses. So that's kind of the added, bonus in what we're doing is we've got that flexibility in the equity gap. We bought it at a discount, and now we can be creative in how we can help people actually get back on track and make payments again.
Now, as you know, and I know, there are a lot of real estate strategies out there.
Mm-hmm.
Is one of your strategies, or is some of yours like, say a customer's got a loan, a fixed rate, and they have hard times, like the job scenario you said.
Yeah.
Do you buy that one out, or do you continue to make payments towards in their name and it helps their credit still? I've seen different ones in different ways. I don't know if you're buying out that loan at a discount and that's what the fund's doing is kind of helping that out, or.
So we've bought their loan outright. So now
Okay.
nobody else is owed except for me.
Gotcha. Then that's fine. And that's explain what still helps them too, that they don't get their credit hurt because you bought the note from them. There's all kinds of ideas.
Yeah. There's so many, and that's what makes it so much fun. Is there's tons of different strategies.
Now, my dad was a banker, and I know you're not technically a banker. You're a individual. Does that particular IRS number, are you audited like a bank? I'm sure there's guidelines.
No, I'm not, which is kind of an interesting twist on it because I'm fulfilling the same role, and maybe I shouldn't tempt fate, but no, we're not audited the same way a bank is.
No, I don't want you to either. My opinion, the government stay out of everything, probably better.
Yeah.
But, I didn't know. I just know that my bankers get nervous. Probably around this time of year, bonds are coming in, blah, blah, blah.
Yeah.
Sign this, sign that. Oh, we forgot this, so forth.
Yeah.
How do you handle insurance? Now I just really got to thinking about that.
Yeah.
I deal with a lot of banks for customers, or anyway, PITI. For those, that means principal, interest, taxes, and insurance.
Right.
I'm just curious how you handle that.
So the insurance is, again, in the perfect world, the insurance was already taken out by the borrower and they're making regular payments. We'll collect a PITI, and the taxes and insurance are set aside in an escrow account and paid on their behalf. if we need to, and I've done this many times, where I'm taking back a property, let's say, and this is going back a few years where everybody was defaulting, but we took
Yeah.
back a property, and then I can do a force placed insurance. So even before I own the property, we discovered that maybe the people passed away, and then so as a vacant property, I don't own the house yet. I just have the note. In that situation, to protect my investment, I can do force placed insurance and still insure the property while we're going through the foreclosure and everything else. And then eventually I'll own the property, sell it, and then at that point, that insurance gets canceled.
Well, that's a perfect example. Talking about, let's say somebody passes away, which happens,
Mhm.
and somebody doesn't want the property or it goes back, whatever, probate. You get it somehow and you
Yep.
own it,
Mhm.
or at least you own the note. And there's nobody there to negotiate with or
Right.
help out. Do you
Yeah.
have a list of investors you call and say, hey, I've got this property?
Once I own it, yes. So
Yes. Okay. Fair
if
enough.
they've passed and everything, then I have to go through the foreclosure. Foreclosure is what transfers the title over to me.
Hmm.
So once I've got title, then yes, I don't generally, like I say, I don't want to deal with the property. So I'm happy just to sell that. Typically, it's usually to a local investor is usually who buys
Yeah.
that. Sometimes I'll sell or finance it and create a new note. It kind of depends on the situation.
I didn't know if you could tell us not, but I love real estate. So
Yeah, yeah.
I got another question here. Hope I'm not boring our listeners, but this is important for listeners to know. So if you decide to go out and buy a property,
Yeah.
and just because you can buy it on the courthouse steps doesn't mean that you're getting that property, because there's always, at least in the United States, I'm sure in Canada probably as well, but Uncle Sam and the IRS takes number one place over everybody.
That's right.
The bank might call it their first place, but if you owe taxes, if they owe taxes on that property, the government's going to get it before you do. So my
Yeah.
question to you, Nathan, is how do you handle that part of? Do you do the research first, make sure there's no taxes on it, or how's that? Or you kind of plan that into your package price?
So yeah, before I buy the note, two things that we'll spend a lot of time on, make sure it is what we think it is the property value. So we're going to, look as much as we can. When I'm buying the note, I'm not buying the property, so I don't have the right to enter the property. However, I do, I'll send a local realtor, they'll go around, do some comps and everything, provide me with a broker's price opinion to the best of our ability. We try to get our best number on what we think that house is worth. The other side of that is title. So we'll run a title search and see, what's going on, and taxes, any other liens will show up on that title report. And then we can just at least know what we're in for. And just because there's a lien on that doesn't necessarily mean it's a deal breaker. But I would need to know, what are the numbers? If we're talking,
Yeah.
$100,000 lien or a $2,000 lien, that's going to make a big difference.
There are two things. We're about to wrap up here. I want everybody out there listening to understand, and I've taught a couple of my friends how to invest in properties,
Mhm.
and I'm hoping you're going to say yes, Chris. You're right. That it's important to know what the property's worth, either fixed up.
Yeah.
And it might be fixed up already, but what's it really worth? Because that's the value of the property is what you're basing everything else off of.
Yeah. And when I'm looking, I want to know today's value. After
Yeah.
repair, it's fine. But my experience has been that people have all kinds of ideas of what they're going to do to the house to fix it up. And
Yeah. No.
especially if owner occupants. I mean, we've been in this house 2 years. There's still, one post where I need to just attach one piece of wood. And have I done it yet? No, I don't think of it at the right time and all the rest. It's sitting right there in the garage, but I just haven't done it yet.
And I guess I'll mention this too. I have one last question, but
Sure.
the appraisals are necessary evil. So don't always go by the appraisal.
That's right.
And they, you know, they have to be done.
Yeah.
Banks require them.
Yeah.
It doesn't necessarily mean that that's the true value of the property. So, one thing they always taught me, I had my broker's license one time. A property's only worth what somebody's willing to pay for it.
Exactly.
All
Yeah.
right. Last thing. So you work with your wife, which I
Yes.
admire.
Yeah.
You always worked with her from the beginning?
Yeah, there was a little time in there right from when we had the curves. It was she and I. And then when I first got started in notes, I had a partner for a couple of years, and he went off to do something else, amicable split. But my wife and I talked about it and thought, you know what, we've always been the best partners. Let's just do that. So
That's awesome. That's what I was going to ask. Was it an easy sell or?
yeah,
Uh,
yeah, it's been really good.
Awesome. Well, Nathan, thank you for your time today.
Yeah, pleasure.
Enjoyed talking about real estate a lot. So if somebody wanted to reach out and talk to you about, I do want to bring up, I'll do it here in a minute. If somebody wanted to reach out to you and talk to you about the fund, how
Yeah,
would they do that?
my website's the best place. So that'd be ernestinvesting.com. And then we didn't really get into it much, but there's a link there to the conference that I run.
That's the part I was going to bring up. It's in Nashville next year, right?
Nashville.
I'll go ahead and give a plug for that while we're thinking about it.
Sure. So it's called Diversified Mortgage Expo. And it is all about note investing. And whether you're brand new or you've been doing this for years, that's the place to be. Just there's no pitching, there's no selling. You don't have to bring out your wallet for anything. You'll never hear run to the back of the room for anything, unless you want to drink water or something like that.
Right,
But that's it. Otherwise, it's just a place where we can come together, network, and hopefully do some deals. That's ideally what we're aiming to do. But yeah, May 2nd and 3rd, Nashville. Love to see you there.
We will put a link at the bottom of the show notes to his expo, the Diversified Mortgage Expo in Nashville, May 2nd and 3rd. And as always, you can find information about Nathan at titansTale.com in the directory of guests. And finally, if you want to talk to me, go to Facebook, Instagram, or LinkedIn, look up Chris Gilman, and I'll be happy to chat with you if you'd like. Just go to my website and set up a time. Nathan, thank you. And we appreciate your time today. You're a great Titan, and Titans like to invest in real estate. So thank you very much.
I appreciate it. Thank you.
All right, bye-bye.